So 2050, what's going on in the world? We're hyper-Bitcoinized. What does that mean?
I think that if we get to the hyper-Bitcoinized state by then we're going to see some sort of combination of different systems, and I think we're going to see full reserve. We might see full reserve with maturity mismatching, and then we might see fiduciary media being issued as well. And that's like, not only is there maturity mismatching, but people are issuing their own notes that are beyond the amount of actual reserves that they have.
Do you think this is a global phenomenon? Like every country will eventually get there?
I guess, a lot of the focus on the writing, it's kind of just like an assumption.
Okay.
And I think that, will we ultimately get there? No, I don't think every country is going to get there. I don't think North Korea is going to get there.
No.
That's not going to happen. But I think like I'm making the bet that I think in the next, 30 years, we're going to see Bitcoin have a very significant role in the world. And I can only imagine if it gets to, if we get a few multiples of materiality greater, as a global store of value, then I think that we could ultimately get, it's something, it is that meme of gradually then suddenly, These things will eventually occur and we're trending towards it. So I feel confident in it. I think it's the best bet you can make in anything right now. It's a great bet to make.
Okay.
Yeah.
So we're in 2050. We only have Bitcoin.
Yep.
We're investing with Bitcoin. We're buying with Bitcoin. Everything's with Bitcoin.
Everything's with Bitcoin. You're thinking about everything in terms of price of Bitcoin. You've got like your investing accounts, and you're like, okay, I got my Bitcoin savings. That's my fail safe. I got some under the mattress that I keep, and then I got some amounts that I keep in like a multi-sig, and then I've got my investment accounts, and then some of those might be, just a Bitcoin position that's earning interest, and that's effectively like the new concept of a banking account. And then you've got, actual investment accounts, because at this point in time, Bitcoin is just this deflationary asset. It's earning a bit in purchasing power every year, but it's not really earning you all that much. And you want to make some long-term bets on some things, and you want to assume a lot more risk so that you can earn a higher rate of return. And that's kind of how the world would work, from the personal finance level on a Bitcoin standard.
But a quick weird question. Why does purchasing power always go up with Bitcoin?
So that's a good point.
And is it only with population growth?
That's a good point. So that's not a certainty. I assume that it will. And basically the idea is if we have a supply increase in Bitcoin, so 2050, it's going to have an inflation rate of like, I don't know, 0.05% or something like that. Who knows? But
it's pretty much the same amount.
Yeah, it's going to be very small. And so I would believe that productivity is going to be growing more rapidly than the supply rate of Bitcoin, because technically Bitcoin's supply rate is disinflationary, right?
Yeah.
And
we're incentivized to save or be prudent.
Right. It'd be prudent to save. So like theoretically, let's assume that productivity were to remain completely flat for the next century. Then Bitcoin's disinflationary supply would be something that's inflationary to disinflationary. But because productivity is probably going to grow much faster than that, then we would probably see a deflationary environment. And then, when you go into concepts in like Jeff Booth's book around general trends in technology and how that's also going to be pushing productivity much more rapidly too.
Do you think we'll have the equivalent of Bitcoin M1 and Bitcoin M2 in that we have Bitcoin sats which are in circulation, and maybe Bitcoin M2 is sats which is time lock contracts, wallets which haven't moved for a long time, that's therefore considered savings?
Yeah, I think that so the way that I see a lot of this building out is I think that we're going to have kind of like a lot of this is based around what Nick Bhatia proposed in 2018 for the Lightning Network, and how we have like this emergent form of capital markets that's emerging on top of it. And we're going to have these like Lightning Network banks. And basically the idea is that like, if you think about how interest rates exist in our current world, we have like a risk curve, and a lot of people like look at like a yield curve, and like that's just like one portion of all of it theoretically. But it's like we have all the assets in the world, and they're all in these varying points of risk, and we have a curve that shows that. And the further down the curve you have a more riskier asset that you're looking at. And we have some of these like base assets that are referred to as being like risk free. And there's a lot of reasons why that's not the right word for them and they're not risk free, but that would be like US Treasury securities or, the LIBOR rate out in London. And that's just like these interest rates are like the Fed funds rate, things that are between different primary broker dealers and the way that they trade overnight with themselves is considered to be, risk free to very low risk. And they're used as a reference rate. Where like anybody who's quoting debt, they'll say like, okay, we're going to take LIBOR plus a certain amount of credit if we're going to give you a loan. That way, if interest rates themselves start to move, we're still covered if they go up to a degree. And then we put a spread on top of that because you have higher credit risk associated with you than the LIBOR rate does. So that would be going down the curve as somebody who has a credit spread added on top of a reference rate. And what Bhatia proposes is that we're probably going to see a new emergent form of reference rate within the Lightning Network because we have a market of liquidity for Bitcoin that's emerging on it. And people are paying different rates for different reasons. And I think like the really salient observation from a lot of that is that it's very distinct from how it currently works in our system because with like LIBOR and all of that, there's some form of like counterparty risk that exists in that basic reference rate, like the lowest rate of risk that you could assume. Without, just holding on to cash. But so because there's counterparty risk associated with that, in this new system with Bitcoin, like the base reference rate would be a rate that you earn on the Lightning Network for just routing payments. And there's no counterparty risk associated with that. So what it means is that like it's like if you were to take like from 0 to 1 on the risk curve, 0 being no risk at all to 1 being the reference rate, we can now zoom in and we've created like new compartments of risk effectively within that curve. And we said like, okay, now you can just assume a little bit of risk of like security risk of where you're, storing your Bitcoin. So like if you want to participate in the Lightning Network, then in order to earn fees from it from routing, you have to lock it into a contract through a hot wallet. So there's technically security risk because you're in a hot wallet as opposed to cold storage. So at the bottom is really like cold storage. And then you move up and you say, okay, we're going to earn a little bit in routing fees. We're assuming more risk. We're getting paid a rate of return now for doing that, as opposed to just like increasing purchasing power of cold storage Bitcoin. So that's kind of like the general idea. And then we have like a new risk curve that's building out. And it means that like, so at the bottom we have the Lightning reference rate, and that's just like earning routing fees. And I can like explain that process. But and then there's the liquidity leasing is kind of like another layer that we have on that. And like with Lightning, one of the big issues and limitations of it, and a primary criticism is you have two different forms of liquidity that exists. It's really easy for anybody to go like open up a Lightning wallet if they want to make payments. You just put your Bitcoin into the wallet, you go make payments to people. But if you want to receive payments, you're limited. And that's because when you're setting up this network, one of the primary constraints around Lightning is that you have a capacity limit on your channel. And it's necessary for the network to exist to have these capacity limits, but they're restraining in terms of how much liquidity that you can have. So if you go and you say, okay, I'm going to set up, me and you, we set up a Lightning channel. And I'm like, okay, I'm going to put, a Bitcoin in, and you're just like, cool, man. Like you put a Bitcoin in, I'm not putting anything in. Then I'll have my side and I have one Bitcoin, and that means I have outbound capacity of one Bitcoin, AKA I can make payments to you or to somebody else of one Bitcoin. And then you don't have any outbound capacity because you haven't put anything in. So you're at 0 on that, but you have a lot of inbound capacity. You can receive payments up to one Bitcoin. So because you have this like empty side of the channel, you can receive a lot of payments. So like the problem is there's not a lot of people in the network who are just opening something up and sitting there with 0 who can receive payments. So if like you're a merchant and you want to go accept Lightning, you have to go find somebody who's going to open up a channel with you, put, a bunch of capacity in there, because if you're, accepting say $100,000 worth of payments a day, then you need somebody who's going to open a channel with you for $100,000 on their leg, and they'll let you just sit there and receive that amount of payments every day. So like that's one of the challenging things with Lightning is dealing with inbound liquidity or inbound capacity. And when people are looking for inbound liquidity, there's things like, Lightning Pool and Magma that are emerging. And those are like these markets that are allowing people to lease that amount of liquidity. So they can say, okay, like I'm Peter, I got, a shitload of Bitcoins in a soccer team, and I'm going to go post my Bitcoins to the market like Magma. and you can lease them for Lightning capacity from me, and I'm going to earn some sort of rate of return on that. So people can do that too. And when you're doing that like liquidity channel leasing, that allows you to also earn another rate of very like low risk interest as well. So like people are earning these new rates of interest before they're like even getting to the level of like, any sort of actual off-chain lending or anything like that. And that's one of the really interesting mechanisms that's going to emerge, because, there's some interesting properties it has. One, like, people can do this themselves if they want. It's very technically challenging, and that's why we're probably going to see Lightning banks. And these Lightning banks are going to be optimizing around that, because the Lightning network, it creates an incentive for you to, connect channels to other Lightning peers and to provide liquidity to the network and earn a rate of return. So like people are going to specialize in that. They're going to have scaled operations.
Is that a centralizing force on the Lightning network?
Yeah.
Is there a risk with that?
Yeah, sir. That's the thing is like, sure. I mean, it depends on how you define risk, right? But like, yeah, it is like theoretically, full stop. It is like a risk, but there's nuance to the idea of like, well, how would any sort of infrastructure operate within a system anyways? And like, if you have a better idea for some sort of purely decentralized way to get that type of transaction throughput, then like, by all means.
Fine.
But it's just like, there's going to need to be some degree of centralization. Every solution we have, whether it's like, federated side chains or something like that, there's a lot of centralization that comes into it. I think that like what they're building with Lightning, it's still possible for people to like operate peer-to-peer. It's possible. It's challenging, requires work, and it's probably not going to happen that way. And there's probably going to be like some type of like Lightning banking system that emerges, and that's going to be a risk, but at least it's on the second layer.
Yes.
And that's
you wouldn't entertain it on the base layer. So that's
right.
Yeah, okay, fine. I mean, what it sounds like to me is that even within Bitcoin, you're going to be able to have a diversified portfolio of investments whereby you have the ability to provide liquidity to the Lightning network, and you can earn it's low risk, you earn a small amount of sats. But at the same time, you can become a capital allocator on the base chain and maybe take on higher risk but have a higher return. But you can actually have a diversified Bitcoin portfolio,
right,
of investments or sources of interest and income,
right. And like, who knows when all that's going to come, but like the theoretical idea is that if we have Taro gets built out.
But hold on, but it kind of exists now. You can provide liquidity to Lightning now. You can lend out your Bitcoin now. I mean,
yep,
it exists already. It's just not a mature market.
Yeah. So like Lightning exists, but I think with like actual like asset issuance.
Oh yes,
that's going to be a ways out. But like theoretically, the idea and the question too is like, do we need it to exist like that? And I think that I think because like I remember I was talking to like a Lightning dev at one point, and they're kind of like, well, why do we need to have some asset issuance on this? And I think the answer that makes sense to me is, right now we have like, if you want to go on a stock, then there is a centralized registry of securities that exists. And that's the thing is like, we could have that in the future, and you trade Bitcoin for it, and there's a centralized registry for those. But if it can emerge in like a, digitally native way on this infrastructure, and these things can be conducted peer-to-peer. Maybe for stocks, it doesn't make as much sense because those are going to need to be like regulated in some form. But I think for like other assets that can emerge, it's going to probably enable a new form of like asset issuance and other types of assets people can issue within the economy in a peer-to-peer way. So I think like the primary advantage is like for the asset issuance to be like native to the Lightning layer. Is if you want to have peer-to-peer asset trade. And then for some of those things, it may not ever actually make sense because we want to have a centralized registry. But, nonetheless, there's going to be a lot of new assets that'll probably exist on Lightning Network, and you'll have like, you'll have your entire portfolio account all existing within a new financial ecosystem.